Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, June 4th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events are weak ISM, labor hoarding, and India's election whiplash. In terms of market implications, yesterday's weak ISM manufacturing PMI report signaled disinflationary softness in the U.S. goods sector, which has become a notable laggard among the global cyclical upswing we accurately presaged in January. Both PMIs in the goods sector broadly are persistent leading indicators of the business cycle, so weakness implies a slowdown in growth in the months ahead. Consensus is already anticipating that outcome alongside a softening of labor market conditions and sticky inflation throughout the second half of this year. We do not yet believe the U.S. economy is on a stagflationary path to recession, but a potential negative inflection in the liquidity cycle and a poor starting point in the positioning cycle make those widely anticipated economic dynamics greater market risks than they would otherwise be. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one reads bonds. It says, hi, Skipper. Thanks for all that you do. Within fixed income, what would get you to change your thesis on starting a bond allocation? I get that the net financing policy will inflect negatively for coupons in Q3 and that 11 trillion needs to be issued over the next year, but playing devil's advocate, would Powell's dovish tone allowing for hypersensitivity to weaker than expected economic data be enough to even think about bonds at this stage? So the answer is definitely yes. In terms of what would get us to change our thesis on starting a bond allocation, that would be a transition within the context of our systematic KISS portfolio construction process. That would be a transition out of an inflationary market regime to a disinflationary market regime, i.e. Goldilocks or deflation. With respect to thinking about that from a discretionary standpoint, for folks who aren't following KISS, you got to think about the time to be long bonds is heading into and during a deflation market regime. What would cause a deflation market regime is a sharper than expected slowdown in growth. So currently consensus is expecting growth to slow over the next 12 months, with a lot of that slowdown kind of taking place in the second half of this year. So you would need to see a faster than expected slowdown than that. You would need to see a faster than expected slowdown in inflation, which should be too hard because consensus is expecting inflation to remain sticky from now through the end of this year. And then obviously you would need the Fed to drop its sort of its data dependency with respect to its reaction function and go back to what it used to do, which is rely on its forecast to guide monetary policy, and relying on its forecast will allow it to pull forward and accelerate the pace and timing of rate cuts in a way that is not currently priced into financial markets. So that's a lot of stuff that has to happen. In our opinion, based on everything we know today about where we think we are in the business cycle and in the market and positioning cycles and liquidity cycle as well, based on everything we think we know today, it's more probable that we transition to a inflation market regime rather than a deflation market regime. But again, that could be in the process of changing as soon as over the next couple of months. But again, we like to think about this in probabilistic terms. Right now, the probabilities are such that deflation is not necessarily the highest market regime that we're likely to pivot to based on everything we know today. So when that changes, we'll obviously report that to our clients in real time. So check back with us for further updates. That will wrap it up there. Darius Dale presenting our macro minute for Tuesday, June 4th, 2024. Everyone have a wonderful day out there. Best of luck, and we will catch you back here on Thursday. We are offline tomorrow. Cheers.